Most people think a health savings account is just for doctor's bills. And, well, it is. But what if I told you it has a hidden superpower, a way to turn it into one of the most powerful wealth-building tools you can possibly own? Today, we are unlocking that power with something called the Shoebox Strategy.
Okay, let's just jump right in with a kind of provocative question. What if the single best retirement account out there isn't a 401k or an IRA, but that humble HSA you might be overlooking? I know, it sounds a little crazy, but stick with me, because the logic here is surprisingly solid.
All right, so the foundation of the HSA's value, the thing everyone talks about, is its famous triple tax advantage. Your contributions are deductible, the money grows tax-free, and you can pull it out tax-free for medical costs. Seriously, no other account in the entire U.S. tax code can do all three of those things. This alone makes it great, but believe it or not, it's just the starting point.
So how do we take this from just a great savings tool to a secret retirement weapon? The key is something called the Shoebox Strategy, and the whole thing hinges on one critical little piece of guidance from the IRS.
And this is it. This one sentence right here is the linchpin. There is no time limit for reimbursement. Just let that sink in. This means you can pay for a medical expense today and then reimburse yourself for it from your HSA 10, 20, even 30 years from now.
So here's how it works in practice, and this is the crucial part. First, you pay for today's medical bills with your regular checking account, not your HSA. Second, you save every single receipt in a super safe digital shoebox. Third, and this is the magic, you leave your HSA untouched, invested so it can grow and compound tax-free for decades. Finally, when you're in retirement, you can pull out every single dollar you ever spent on healthcare completely tax-free by reimbursing yourself for all those old receipts.
But listen, there is one absolute, unforgiving rule you cannot break. You can only save receipts for expenses that happened after your HSA was officially opened and funded. Anything before that date, it's ineligible, period. The second you become eligible for an HSA, you need to open and fund that account, even if it's just with a small amount.
Now, as you can probably imagine, a strategy that spans decades is going to require a little more than a literal shoebox full of faded paper receipts. It requires a really serious, disciplined approach to keeping records. This is the price of admission.
Yeah, the IRS has specific rules for digital records, and they are not suggestions. Your system has to keep records that are legible and accurate, protected from being altered, and organized so you can find what you need easily. And of course, they have to be backed up. This isn't just about good habits, It's about building an audit-proof case for every single tax-free dollar you plan to withdraw, maybe 30 years from now.
And when I say proof, I mean more than just a credit card slip. To be totally safe, you need the full story for each expense, the explanation of benefits from your insurer, the itemized invoice from the provider, and proof you actually paid it. Think of it this way. You are literally building a legal case for every dollar you plan to take out tax-free in the future.
But here's the thing. While this strategy is basically a masterpiece at the federal level, it hits a major snag in a couple of states. For folks living in California and New Jersey, there's a pretty significant administrative headache you've got to deal with.
So for residents of California and New Jersey, the HSA is just not a tax-advantaged account at the state level. Your contributions, not deductible on your state return. And most importantly, you have to pay state income tax every single year on all the interest, dividends, and capital gains your HSA earns, even if you don't take out a penny. This is often called phantom income.
Now, the real challenge here is that your HSA custodian won't send you a special state tax form for this. I mean, why would they? The account is federally tax exempt, so that means you, the taxpayer, are on the hook for combing through your annual statements, calculating all the taxable earnings, and manually reporting them on your state tax return.
And on top of that, to avoid getting taxed again when you eventually withdraw the money, you have to track something called your state basis. Basically, this is a running tally of your contributions plus all the earnings you've already paid state tax on. It's a multi-decade accounting project, and yep, you're the one who has to get it right.
But even if you totally master the record keeping and navigate the state taxes, there's one final, really dramatic risk that can turn a too successful HSA into a massive tax liability for your loved ones. I call it the inheritance tax bomb.
This chart right here shows the huge difference in outcomes. If your spouse inherits your HSA, there's zero immediate tax. It just rolls over and becomes their own HSA. But if anyone else, say your child, inherits it, the entire value becomes fully taxable income to them all in a single year.
Let's break that down a bit. For a spouse, the account just keeps going, maintaining its tax-free status. But for a non-spouse beneficiary, the account legally stops being an HSA on the day you die. The full balance gets paid out and is taxed as regular income, which could easily push them into the highest tax bracket.
So just imagine you followed the Shoebox strategy perfectly. You've diligently saved and invested for decades, and now your HSA is worth $150,000. You've built up this fantastic nest egg. But if you pass away and your child inherits it, that entire $150,000 gets added to their taxable income for that 1 year. The tax-free growth you so carefully cultivated for decades gets slammed with a massive one-time tax bill. That's the bomb.
So, does this mean a too successful HSA is actually a curse? Well, not necessarily. Because, amazingly, the very strategy that created this whole problem, the Shoebox strategy, is also the key to defusing the bomb.
You have to start thinking of your lifetime of saved receipts, not just as a way for you to get money out, but as a strategic asset for your heirs. It's like a post-mortem salvage operation that can save them an absolute fortune in taxes.
So here's how it works. The IRS gives non-spouse heirs a 1-year window after death to pay for the deceased person's final medical bills from the HSA tax-free. But, and this is crucial, this also applies to any past qualified medical expenses you had that you never reimbursed. Your heir can use your shoebox of receipts to withdraw tens or even hundreds of thousands of dollars completely tax-free and neutralize that tax bomb.
But look, this entire thing only works if your heirs know this shoebox exists, know what it's for, and can actually access the records. If your digital archive is locked away on an encrypted drive with a password that only you knew, well, this whole salvage operation fails. Communication here is everything.
So in the end, the HSA really has two faces, doesn't it? On the surface, it's a simple, helpful account for paying today's medical bills. But hidden just underneath is this incredibly powerful, high-maintenance financial engine that demands rigorous record-keeping, careful tax planning, and a really thoughtful estate strategy to truly master.
The potential is just undeniable. I mean, an account that can give you tax-free growth and tax-free withdrawals in retirement is basically the holy grail of financial planning. But it requires decades of discipline. So the final question really is for you. Is the immense power of the Shoebox strategy worth that steep administrative price?